With the expectation that the Fed is going to start cutting rates in September, how may this affect mortgage rates? Let's be clear, the Fed does not set mortgage rates outright. Their decisions obviously play a role, but even when the Fed keeps rates unchanged, mortgage rates can fluctuate. The Fed sets borrowing costs for shorter-term loans, the Fed funds rate, which dictates how much banks pay each other in interest to borrow funds on an overnight basis. But most mortgages are based on where the 10-year Treasury yield is. However, fixed-rate mortgages are not the same as the 10-year yield, and there typically is a gap between the two. We have already seen mortgage rates move lower on the anticipation of Fed rate cuts. The likelihood is that an initial cut in rates will have very little impact on rates at first. Further, while we have seen a gradual drop in rates, home prices have not fallen with them. The demand for single-family homes continues despite rates being where they are, and lower rates initially may only increase that demand. But if the Fed continues to cut rates through the end of the year and into 2025, and inflation moves closer to the 2% benchmark, we could see a considerable drop in mortgage rates as the 10-year yield should also continue to move lower.